Time for the market report. Zach's got the updates for us.
That's right, Jonah. Row crops going up while livestock going down. How much did Ukraine affect that? We'll see. But first, the numbers. Last week's biggest gains and losses. What do they have to say? And then in our row report, weather the biggest story. And finally, we talk about livestock and 2 USDA reports on cattle and catfish. So, in the markets, row crops rising while livestock going down. We'll get into the reasons. But first, let's take a look. Last week's biggest gain, wheat, up 36 cents, close to a 5.5% gain. Last week's biggest loss, lean hogs, down nearly 12 cents, a nearly 12.5% drop. In this week's row report, we talk about rising grain prices, especially wheat. You'd think the recent Ukraine trade deal ending would be the reason, and it is a factor. But for the U.S., it has more to do with weather, at least according to Elaine Kub.
You just pointed out all the ways that these markets have jumped up a little bit this week, but I think we could argue that it is only the weather, or the weather alone could have done it. And I say that based on the lack of evidence in the cash wheat market that it has reacted in any way to this news from an export perspective. There's still extremely weak wheat basis in Texas, for instance. We are not suddenly seeing some new surge of exports going out of the Gulf in response to this. And of course, it could take some time, but I just wanted to emphasize the point that just because this is a disadvantage for Ukraine, or a tragedy perhaps for folks in the global south that need that food, it is not necessarily being translated into an opportunity for U.S. wheat producers given the current state of our exports. I think some of that longer term forecast has been built into the new crop prices, because that ridge is expected to proceed even into August, and it is not helpful, and particularly in the areas of the Corn Belt where they plant such aggressive hybrids, and we're aiming for 300 bushel per acre corn, and we see such really disappointing crop conditions. In Illinois, for instance, less than half of the corn is rated good or excellent, and any of the yield models that the USDA or any private estimator could come up with, there's lots of pockets that are very dry, and so you could have a neighbor that is 20 miles away from somebody else have completely different conditions. It's a really difficult thing for anybody to try to model the yields at this point in the growing season. So the soybeans, you have both a fairly bullish yield scenario because they're facing the same stresses from the hot weather while they're blooming, but you also have the continued loss of acres that came in the last USDA report. And I hesitate to get real bullish because I don't want to discourage farmers from selling at these very profitable prices for soybeans. It's more of a interesting gamble for somebody who has gambling money to do, for a speculator perhaps, or somebody who doesn't need any cash until January, to probably wait to really see these bullish implications of this weather that we're seeing today really play out in the markets. It may take months for it to really be reflected.
In livestock, last week the USDA released its cattle on feed report and a catfish production report that we'll look at first before cattle on feed. For U.S. catfish, water surface area down 3% from last year, food size inventory down 6%. Broodfish, the parent fish, up 22%, and stockers for ponds and whatnot down 15%. In this month's cattle on feed report, cattle and calves on feed down 2% compared to this time last year. Here's what Elaine Kub has to say about it.
Certainly, the cattle on feed was more explanatory for why we have seen such strong cash cattle prices in the past couple of months. The marketings were down 5%, which is a big number. And so we did see cash cattle prices $180 on a live basis in the south and $295 dressed in the north. So they are very strong. That was a jump of $2 to $3 once again this week. So the cattle on feed report was explanatory, but going forward, the placements were again down more than folks were expecting. The cattle inventory report was showing down 3% for beef cattle. And to me, that just reminds us all that this is not just a flash in the pan. This is not 2014 where we immediately rebuild the herd and prices go away. I think these prices will be sticky because the scarcity of this cattle, this continues. This is a continuing thing that's going on according to these reports. There is a play between folks going to the grocery store and choosing pork or beef, but I will clarify that actually beef prices have been softening in the past few weeks, which is partly seasonal and perhaps a reflection of price rationing. You've got the choice cutout is coming down to 300, which is going to challenge packers. But packers are starting to get more for pork. So the pork is going the opposite direction lately. It has been continuing to grow since June. 115, I think the pork cutout was at this week. So that's actually fairly favorable. I don't think that we'll be able to see that in the futures market carry on much past this nearby futures contract. Once you start looking in October and onwards, there's, seasonal weakness.
And that's it for a deeper look into the markets. Interesting week. Next one should be too.